Okay, so your volume changed a little bit, which means that's going down, and so the parish should be out 373,000. Option C is one in which you could say, this is an option that we could bring in a supplemental plan that allows your active employees, which I would recommend anyway, because your supplemental plan now really limits them to just $50,000 in life insurance that they can buy for themselves. Typically, you want them to be able to buy 8 to 10 times their annual earnings if they want to. But we could bring in a plan that would at least get it up to $200,000 maximum, $100,000 guarantee issued, so they can buy more for themselves. And by doing that, it would put more money into the plan, whereby the insurance carrier would be willing to lower the rates on retirees because you have more premiums coming into the pot. If you look at option D, and this is one that you may not want to consider at all, but I had to put it on here, is that you do away with the retiree plan. And that's just something that you would have to decide upon what you would want to do. All the districts I work with, none of them have retiree life plans. That's just different. I deal with a lot of them in Texas, Illinois, where they have collective bargaining agreements and everything like that. They don't do a life plan for the retirees. So, and many companies and carriers probably don't do it anymore either. It's just one of those things that by the time a retiree hits a certain point, they've either got, like for instance, most of them will use like your TRSL. We have different ways of taking your annuity, and that can leave something to your beneficiaries, and they use that as life insurance. I mean, this is only a $10,000 policy, so this is certainly much more valuable the way you make a decision here. So many companies and districts look at it like, well, that's something that they can do over there as well. So, but that's just an option. I put it on here. You may not even want to go there, but I just had to make sure there was an option available to you. By the way, if you do this option, the UNOM has stated that they will work with the covered employees, covered retirees, and they'll let them convert their policy to a permanent policy, which of course would be much more expensive for them. I understand that, but it goes all the way until death. You know, it goes all the way throughout their lifetime. So it's a different type of policy, so that's why it's much more expensive. And that kind of brings us back to the fact that, well, we're using a term life policy to actually act like a whole life or universal and permanent policy, and it's really not the same thing. The last option, E, is if you said, okay, well, we'll just have a budget every year of what we can spend for retiree life insurance. And then you give that over to the insurance underwriter. You say, how much insurance can we buy for our retirees if we're saying we're willing to spend X amount of dollars per retiree for life insurance? That may be another option that you can do in the future if you want to do something like that. And you just cap off the amount that the parish is going to pay for life insurance for retirees. Again, that's just a few of the options that you have to look at going forward. Like I said, the retiree right now, for every dollar that your parish is paying on basic life for the active employee, the carrier is paying out $1.33. For every dollar you're paying in for the retiree, the carrier is paying out $4. The way they're able to make it up is in the supplemental purchases of the supplemental life insurance. Because people are buying on an age-banded basis, so they're able to make up that dollar amount to help fund everything that's going on here. But still, the loss ratio of the last 4 years is up 91%. And your carrier, they have to make something in the neighborhood of a 71%, 75% of all the loss ratios. Now, one of the things is that you can certainly keep doing what you're doing. Eventually what's going to happen is that on that graph that you saw a while ago, your retirees will eclipse your active employees as time goes on. And certainly the rates will continue to go up. At some level, they'll go up to a point that A, you cannot afford them, or B, the carrier says we can't want to afford you. And this is not an automatically guaranteed enrollment product, so they can cancel it.
Philip, any questions?
I'm sorry.
Yeah, I had a question.
Yes,
I'm
sir.
looking at option C here, and I'm trying to make sure I understand what you're trying to convey to us. Basically, right now, our policy caps the supplemental offerings at $50,000.
That's correct.
And if I'm understanding correctly, if we allow y'all to offer more as far as supplemental insurance, the company is willing to give us a reduced rate of what we're offering,
Right.
regardless of conversion. In other words, if we simply offer it to our employees,
Right.
regardless of what they actually purchase, as long as we give them that option to allow that purchase, then the company's willing to work with us because they're pretty sure they can insure enough sales to cover.
You have a good participation rate on your supplemental policy, which is a good credit to you. I think more employees need to make sure that they do have a good policy. And I think it can be a combination of term and firm, which you need. Matt, who's on the ground here and will be working with you, they would put in that enrollment opportunity, and I think that enrollment opportunity you're looking at in September. But I would say this is the lowest amount I've ever seen them offer to supplemental insurance. Most of the groups I work with have a $500,000 policy, and they have a guarantee issue of $150,000. So I think it would be advantageous to you to do that, regardless of what your decision is on anything else. I think it'd be advantageous to do that.
Do we have a number of retirees?
Yeah, 3,000 retirees.
With insurance.
With this insurance,
They all
with this life
have, they
insurance.
all have basic life. And if they don't have health, then that's a gift we give them.
And just to let you know, and you can go out for yourself on the official school schedule of premium rates for 2018 for Office of Group Benefits. That's the other group that's large that does a lot of this. This is looking at going to $2. Their age group at 65 is $2. And the district and the employer, the district and the employee got to provide in that. They have to share in that, half and half on that premium. On age group 65 to 69, they're charging $2.52 per thousand. Again, this is $2, and then you look at going and lowering it even more. And at 70 years older, it's $2.48 per thousand. So you compare pretty favorably to things that are already going on for this next year for this group, which is a pretty large group.
So what are you looking at? Are there any changes like for us?
Not for 2018, but we're starting the conversation about what are our options? How can we maybe improve our situation for 2019?
It's a long time on life insurance, you know.
Well, the
Yeah, I've probably paid, certain I've paid over what I'm gonna get.
The supplemental won't change.
Over a period of years.
The supplemental will not change.
It's not the basic. That
It's
basic
just the basic
10,000.
amount that the parish pays.
And under option C, we can receive a reduced rate towards the plan policy for the flat 10,000 that we offer. In exchange,
Okay, let me make
quid
sure.
pro quo there is allowing them to purchase the supplemental plans at a higher rate.
Yeah, okay, so Plan C is to say, there's two parts to Plan C.
Okay?
One is that you reduce the amount that you provide to retirees to $5,000. And the second part is that you offer this, the supplemental plan.
Our ability to
Keep in mind, retirees' income,
yes,
it
I'm
doesn't
sorry.
change.
What's that?
Retirees' income, it doesn't change. So if you start talking about a higher rate,
No, we're not charging anybody a higher rate. We're not dealing with anybody that's already paying for the life insurance on the supplemental piece. That doesn't change.
okay.
The only piece that we're talking about is what the parish pays. And so That's going to go up regardless of what you do today. The bill's already been sent out for January, and it'll be for the entire year, unless you change something this year. And certainly, I work with a lot of other large insurance companies are all A+ rated, and I can take this out. I can tell you right now, me taking this out to the market will not do you very many favors because of your high loss ratio. Don't look at that thought favorably because they're in the process of making money, not losing money. So they have to have an equitable trade, if you will. They have to have equitable pay for the risks they're taking. So I would like to take it out when you decide what. Certainly, I would be willing to help you any way that you want to help. Take it out if you need to do that. But I think that's a good question. Option C looks at reducing that. Now, what I will do for you, I can go back to the carrier and say, what if we want to keep it at 10,000 and we still want to put that supplemental plan in there? What can we do with the rate?
That would be a good option. That would be a better option.
Yes,
Okay.
that's a better option.
Well, let me tell you something. Let me go through one more thing. Is that you do know that you have reduction amount as you go through. So a number of your retirees are already on the 5,000 level. So how many would it affect? It may affect 3,000. Let's say it affects 2,000 of them. 1,000 of them are already at the 5,000 level, so that will change. So you will all retirees will eventually reduce. They live to their 70, they'll eventually reduce to a $5,000 policy anyway. So that's something to think about as you go through your discussion.
We get, not to be morbid, we actually get the numbers as far as what mortality we actually see in that group of people that would be affected if we did drop it down to 5,000.
I'm not sure I understand the question, but
There's,
how many people would die?
yeah,
Say 2,000.
what is the death rate, you know?
Yeah, I mean, what's
How many people?
If it says affected, meaning died before they're 7, yeah.
Yeah.
I mean, again, you're looking at what 82% of your claims coming out of that group. I don't have it broken down by the number of ages that were.
Because in actuality, the 2,000 people that you were saying were being affected, they're not affected unless that occurrence actually happens to
That's a
them.
good point. That's a very good point.
I think I know what you're asking now.
You know, so let's get the real numbers as far as based on past numbers, history, how many people would be projected for this to
But he's
affect?
asking like what percentage of people under 65?
What's the projection from an
Claims.
actuarial basis?
Yeah.
How many people would die between the ages of 55 and 65?
Yeah.
And
Our auditors will work on it.
I'm sure we have numbers.
Yeah.
Come on, that's.
No, that's a good question because you do need to know how many people will be affected. Now, the other thing to think of as you're thinking along that line is, what do you do in the future? I mean, the actuaries looking in the future, how many claims they're looking to have, is that at some point, do you want to say, no, this really isn't something that we want to do in the future? I mean, you may look at saying, you know, maybe we keep everybody on it. We've done this before with other programs where we did a closed class. So we just close that class off. Nobody in the future will be added to that class. So no retiree in the future can have that. I strongly recommend you consider that because you will not be able to go down this path unless the parish is going to spend more money. Your rates doubled now. Your rates will double again in 4 years, and then other carriers will not be wanting to touch it because they know it's going to be a thing waiting to happen.
So by closed class, you're saying?
Close it off and
Everybody who retires has a
Yeah.
So if we are trying to attract teachers and retain those teachers, that would be a benefit we would not be offering them. It would just be offered to the people you have.
yeah, and I understand. I mean, prior to doing what I do now, I used to be behind the desk of a large school district, and teachers coming in that district, that's the last thing they thought about was retirement or retiring life. And they never even thought about that. What they thought about was healthcare, my days off, sick leave. Sick leave, healthcare, how much am I going to get paid?
When's Friday here?
And when's Friday going to be here? And do I have to have this class? So that's what I ended up having more conversation of. Retiring life is not a way to sell a benefit package.
And then you have supplemental.
Do we know what adjacent parishes are doing? In terms of
I've
what they provide?
already heard from one parish cutting it out. I've already heard
Which-
another parish that's, Cameron dropped it. And then, how do you say that? Wachita.
They're not adjacent, I'm talking about Vermillion Parish, like the other parish.
We'll find out.
We can find out, but I think some of the other parishes that we've talked to, they're looking at, I think they're having to face it because it is getting expensive. It is. And you don't think it's expensive when you think it's just my $2 is paying or $10 is paying it, but when you multiply that by the number of people and then you multiply that by the number of years you have more people being added to it, it increases quite substantially. But I think there's a lot of other benefits. I think the benefit of being able to buy more insurance on yourself at a reasonable rate, I think if you wanted to do, I think putting more of the benefits into that thing would be attractive to your employees coming in versus the retiree. Because, like I said, again, term life is for a term in your life. Matt's group, if they do a great job, what they will do is say, buy enough term, you may buy $100,000, $200,000 in term, and buy a $50,000 term life policy that you can carry long term. And when you're 27, 30 years old, it's affordable. Later on, it doesn't become affordable. And that's what's happening here. And actually, as I said, if you compare it to some other places, it's actually a bargain right now.
The option you offered, I don't remember which one it was, where you said that you could convert the term to whole life. I mean, the cost of whole life insurance for a retiree would be cost prohibitive. So that's really not an option. I mean, they just can't.
That's not an option, in fact. But I will tell you that all the school districts right now that I see, they have a term life policy. Less than 1% of the people ever port their policy when they leave to go work for somebody else. Less than 1% ever convert it. Most people either had a life, they either have, I mean, because $10,000 in life, most people either have an asset that they can use that, for $10,000. I think most people in their mind think that $10,000 is a very good policy. And at this point, they say, I have enough assets that my kids can sell my house and sell my belongings, and they can bury it. So
There are a lot of people that don't think like that.
that's true.
Yeah, so let's look at the opposite side of
But
it.
that's why you
A
have
lot of
this
people
guy.
A lot of people don't
that
understand too, with the term life.
Right,
You
'cause
pay
they
and pay and pay. You hit an age and family's
And it's
gone.
gone.
It's gone.
They're not gonna buy a term. I wouldn't.
Learn from the experience
No.
of
Yeah, I
that.
wouldn't.
I would always buy enough term life. No, I would, because comparing the rates of the term life to the whole life or
What
permanent
I'm saying though
life.
is you pay for that umpteen years, and then when you hit the golden
It's
age of
gone.
70, all of a sudden it's gone.
But a lot of people will not want, they don't need it at that point. They
Seven?
really, no, they don't need it. They have a mortgage paid off for, they have kids out of college, they don't really have that many more expenses, so they don't really feel like they need the term life, and they have retirement plans they're getting. So I would say the majority of people do not feel like they need term life after a certain period of time. That's why they use term life. That's just some numbers we see in the industry. They don't want
Look
to
at some comparisons. If you pay your term life and you take the difference between the term life policy and the whole life policy and invest that money yourself, you end up way off better, because what you're doing is giving the money to the insurance company who invested, takes a cut, and then gives you some of it back.
Exactly.
That's
Everybody does think like
bingo.
that.
I think a lot of that, no matter,
Now-
probably today, a lot of that is discussed a lot more, people are more aware of those type of things. I think when all of us started, we'll go years ago, you just, whatever you told me to sign up
That's
for, I mean,
right.
I don't ever remember, I have to say, when I started, anybody ever sat down and said, okay, this is what insurance, this is what you have, this is what you want, so I don't think I've ever, So I just, whatever they told me, I did. And I think the vast majority of people who are in my age group and who have retired are pretty much in that situation too. Today might be a completely different thing because they're more, the discussion is there, there's more aware, more awareness. But as far as like, years ago, you just didn't have that discussion.
That's why we had term life. We didn't
There was no
understand.
discussion of 403s or anything
No.
like that.
Right.
We were
No.
on our own.
Well, one thing
I'd like
that
for us
you
to
just
know-
Oh, I'll apologize. Go ahead.
I'd like for us to seriously consider going ahead and seeing about trying to recommend an increase as far as the supplemental policies. I don't see that there's a reason for us to be capping that at 50. There's no cost to our plan for that. And if we can work towards getting a reduced rate, maybe we don't hit the $1.50 per thousand for the retirees, but maybe we get some reduced rate by offering that supplemental. I think that's an avenue worth pursuing. Now, whether we drop it down to 5,000 or 10,000, I think that's a different decision. Also, I like for us to investigate the possibility of doing a grandfather clause on this, as far as let's phase out the retiree part.
Close claims.
But, and we can't take any action tonight, because I don't think our bylaws allow. I think we have to present it to our individual groups that we represent. So
I would definitely go back and talk to your folks. And I hadn't intended for us to make any decisions tonight, just to start talking about it.
One question I came up with, and I just asked Todd, if you go with option C and offer the higher supplemental, close the class, would the people retiring take their supplemental, would they be able to take their supplemental with them? And the answer is yes, they would still be able to take their supplemental with them, even though you close the class to retirees for employee
Just for
pay.
base.
Yeah. So that's one
That's
option.
interesting.
And another, when you said buy term, invest the rest, it's a coin term from like the 50s or the 40s. It's very common. But also from someone that's on the ground, we talk to people every day where $10 out of the paycheck is huge. And so they don't have the option to invest the rest. You know, they need the most economical option, and you know, at least during active years, employer paid is a huge benefit, and they take advantage of the term, and quite possibly it's their only option once they start to retire.
what is the savings to the board if you did increase the supplemental and you close the class at whatever period it was decided to close?
Well, the closed class, I mean, the savings to the board would be that you wouldn't be paying for the next group of retirees going into the plan.
But you'd also have, wouldn't you also have the savings?
There's still, I mean, I hate to be morbid, but the thing about it is those 3,000 lives represent 3,000 deaths are going to occur.
So that's where the savings
So
would
they're
go.
going to drop. Right. And the only savings that would be happening would be as these individuals mature into the age of 70, where there's only a $5,000 benefit, that would help some. But again, you're just going to have to see how long you can be able to do that, because I'm almost assured, based on the fact that right now they're paying $4 out for every dollar you give them in claims. That doesn't cover any administration. So every dollar you give them every year, they paid out $4 in claims. They're not going to be able to sustain that very much longer. And the only way that they're able to sustain it is that you're throwing it out onto the supplemental plan to help boost up the amount of money there.
Do we know how many of the retirees on the graph are over 70? And how many are under 70?
I think when I was talking to Ms. I think it was somewhere in the neighborhood of maybe a third or 70 or above.
So if we to grandfather the class, would that in essence take the pressure off of the premiums that the active people are paying for life insurance, because they wouldn't have to subsidize that?
Not at this point, because you still have, like I said, you still have those 3,000.
But over time.
Over time, it'd be, however long it takes that time curve that, you guys might be retired by the time you ended up getting to that point, because 3,000 lives that being able to get to 70, I mean, still at 70, they still have half the policy. So that's still an exposure. So let me look at it this way. If you looked at, if you were able to knock out, for right now you have $21.8 million exposed in these 3,000, in these 2,900 employees. That means they're going to be paying out $22 million in claims.
How many employees you said?
That's 3,000, or 2,900. So that's $22 million in claims. Waiting. Because it's not a matter of if, it's a matter of when. At this point, because that's what you're saying. You're saying we're going to cover you until That's right, so that's what you put with the carrier to do so. So what's going to happen is that as that participation goes up, your rate could go up. They probably go up like this because we have more deaths. You know, you're not going to say that increase this day, we have more deaths this way. I mean, I just, it's
But
kind of,
didn't
it's
you-
math. It's a math question.
Didn't you indicate that we see if we increase the supplemental and close the class, that would be more amenable?
Well, I think the situation is that anything that you can do to start reducing exposure, to start reducing the risk helps. It doesn't mean that it goes away. It doesn't mean that, you know, there won't be increases in the future. It just means that you started containing some of the risk.
Gotcha.
So closing the class automatically, you know, like I think there was like 150 people that went to retirement every year. Okay, so let's say you start this in 2019. And that 150 won't go into the class. Okay, and then the year you get down there, there'll be deaths in that class. And then next year you will add another 150. But if you don't close it, next year you add 150, year after that you add 150, year after that you add 150. And pretty soon, this little line, become a really insurance company because you're going to be covering more people retired than you have in your district.
People are retiring early in life. They're not going 30 years, 40 years.
It varies, I guess that answers your question, but a lot of them are not staying past 25 or 30.
That's what I'm thinking.
Oh,
Whereas
yeah.
in the past, it used to be 30, 33 for long. But it seems as though they're retiring in plus years, which means they're retired for longer years.
Right.
And people live longer.
Under the policy, I think they only have to have it for 5 years before they can keep it basic. Is that correct? That's what I'm understanding. They only had to be here 5 years of service to get the life insurance, the retiree life.
I just know we have
I think you have that in the policy.
Wait a minute, so we're vesting people their life insurance after 5 years?
Yeah, we pick that up, maybe that's part of the process.
I think that's in the policy. That's what I saw earlier.
As long as they retire.
Yeah, as long as they retire.
If they leave.
No, that they leave, that's not. But if they retire and they've had 5 years in the service. But I will tell you, that still won't really solve your problem. That just got to be honest with you. That's probably not going to solve your problem.
Any more questions about life insurance? Thank you, gentlemen.
Thank you.
Next item on the agenda, retiree vesting.
I wanted to share with you guys a proposed amending our vesting schedule. And let me explain what this is all about. And you guys are welcome to leave if you have a
I didn't know if you
obligation.
needed it or not.
No, you're welcome to take off. It's not an obligation.
Thank you for your time, and
Thank you.
I look forward to serving your needs in this.
Thanks a lot.
Thank you very much. Merry Christmas.
Merry Christmas.
And Merry Christmas.
Merry Christmas to you guys.
The vesting schedule is something we passed a few years ago, which results in people who retire with fewer than 10 years of service, 10 years of service on the plan, enrollment on the plan, are penalized by paying a higher penalty. When we came to you guys about in 2015 and we had to amend it, we admitted is that we could not, under that old payroll system, administer it. So under the new payroll system, we felt we were going to try to program it. Well, I found out that the way we have it structured, we would have to come up with 250 payroll deduction codes in order to administer it the way it's written right now. So what I did was, and also we would have no way of telling people, it would be very difficult to explain what their penalty would be. So I sat down with the different class codes, the different plans, and I came up with a flat penalty. And it's based on the average of what the penalty would be in all of the 25 class codes in each plan. And this is what I'm proposing, is that we have a set amount of penalty so that when somebody comes to us and says, I'm going to be penalized because I've only been on the plan for 5 years, what is my penalty going to be? and it would be on this chart. Well, if you have the basic PPO, your employee and dependents, you're going to be penalized $365 a month. That's what you're going to pay more than anybody else until you reach year 10 and the penalty goes away. Or 5 years, I'm sorry, would be, yeah. And then with your 10th year, it would go away. So that's what I'm proposing here. What I'm doing, how I did this is I take from, the half-cent sales tax portion of the premium from the board is dedicated. I can't touch that. That's by law, that's what's put in. So I went to the general fund portion, and if you're in year, chart 1 was 1 to 5, I'm not giving you any of that general fund portion contribution. I'm moving it from the board to the employee. And that's the penalty for 5 years. And then in years 6 through 10, I'm halving that. Okay, the board will put in half the portion, and you'll pay half, and it'll go away. And so this is programmable. We can do this. Program that within days. We don't have anybody right now who's retiring that we need to do this with, but we will have some at some point. Also, I have the category for an employee and their dependents because, and then one with just the dependents because sometimes maybe I served 20 years on the plan, but my family came on near my retirement because my husband's job changed and they came on. So I just got to penalize the dependent coverage, not the whole.
No, I'm just saying.
So that's what I'm throwing out there for your consideration to recommend that we restructure it this way. If y'all want to study it a little bit longer, let me know. Or if y'all want to recommend that we have to take it to the board. You want to look at it?
Okay. According to the bylaws.
Good.
But you said that this would not affect any current retiree?
As of 1/1/2017, we would have to apply it. Yes.
18 or 17.
Well, we had said 18. 1/1/18.
So it would not go in effect until 1/1/18. Mr. Smith?
Do I need to speak into a microphone?
No, he said the room was fine.
Oh, okay. That's
I don't know what that means.
I said
I think it sounds like it's bugged.
I'm going to really keep it under my breath here. Is there a reason why the policy was changed from employees who were employed from 10 years to employees who have been enrolled in the plan? Because I remember very specifically when we had this conversation 2 years ago that we changed it from employees enrolled in the plan to employees who worked for us for 10 years.
Well, I think it's a recruitment problem. If you have a situation where somebody teaches in Lafayette Parish for 20 years and her husband was transferred down here and she finishes up the last 5 years here and retired at 25, if she joins the plan at the time she's hired and she's on the whole time she's employed, I don't think it's fair to penalize that person. Somebody who has joined the day they were hired. I think it's a recruitment problem, particularly you might have somebody really brave in St. Martin Parish and they want to come here really badly, but they're held hostage there because they know they're going to retire in 5 years. They're not coming here because they're trapped in St. Martin Parish because of this. And I hate to see that happen. And that's why I was proposing to go back to enrolled in the plan.
Well, but that person would still only get 50. I mean, it's a person who comes and spends 5 years here, the employee who spends 5 years here, enrolled in the plan or not, they're still vested the same percentage.
No, I'm suggesting that you have
Under the current.
Under the current, yes.
So they're not penalized at all.
Right. Yes.
What do you mean? Yeah.
Well,
They're
I mean,
not
what do you
penalized
mean
at
they're
all.
not penalized at all because they haven't retired yet?
Because the current policy says as long as you worked for us for 5 years. It doesn't say you have to be on the plan for 5 years. It says as long as you worked for us for 5 years, you vest.
I thought we put that change in several years back that we did the investment as far as in the health plan itself.
That's what
In
I thought so
2015,
too.
in 2015, the board specifically said for employees, if you work for us for 10 plus years, you vest 100%. For dependents, you have to be insulated.
Okay.
Right,
Specifically
it is.
to catch the situations where someone comes from Lafayette Parish to Lafayette Parish for 2 years, and we're stuck paying 100% for both them and their dependent when we never saw it until it was time to pay.
Well, that's a risk every employer takes, really. I mean,
No, I mean, that's the policy now. I'm asking for a justification of why we should change it. That's what I'm doing.
okay, so
I'm asking for a justification of why to change the vesting
2 years
from what it is
on the
now.
plan, 2 years employed versus years on the plan.
From years employed to years on.
Right, and I'm saying because it discourages people from coming here if they know that they're not going to be working 10 years for us. Or even 5.
The same situation handles, like, you're not solving that particular situation.
Yes,
Change.
yes.
No,
I am, because if they join the day they're hired and they only serve 2 years, they're not penalized as long as they didn't spend time working here, not on the health plan.
Do I not understand what a late applicant is? Is that?
That's right, a late applicant
I'm
is
sorry.
someone who comes to work here and does not join the health plan and joins way further in their career. That's a late applicant. So they did not join when they were first had the opportunity. So if they don't serve that 10 years, they won't get the full funding until they've been on the plan.
I've always thought, and maybe we could get a copy of what the actual, policy is.
It was attached.
I always thought that it was more, it's not as much the employee as opposed to spouses or dependents.
That's covered
In
under
other
here
words,
too.
that was, they had to be in other
Yes.
words, they had to be in it 5 years and then get, have a
Because that
benefits and so on.
That policy was passed because we had some people who, in their last year 19, put their spouse on it. And-
Yes.
And I remember when we
And
did that.
that's covered in here.
Right.
That takes care of that situation.
We had to also have, we had people that would be in this system for 25 years, and because their husband worked for Chevron,
Absolutely.
That's why.
they would not join the health plan until their last year before they were going to retire.
Which was the point, which was the reason why we made the change that we did, was if you work for us, that's cool.
It was
This is a
okay.
benefit for you working for us.
Okay.
Whether you choose to take advantage of it or not, we don't want to penalize you just because you have better options than what we were.
But if you work in Lafayette Parish for 20 years and you knew you could retire in 2 years and you start shopping insurance and you jump to the parish with the best plan and then work for 2 years and retire, and then we're financially responsible for you for the next
But how
25
many people do you
years.
think do that enough to penalize so many people?
But then we can change the number of years, couldn't we do that? If you're gonna do that, come here 2 years and retire, well, why can't we say you have to work longer before you can get the health insurance?
That's what we're saying.
Before you can get it, or
I mean, before you can add yourself, your spouse, and children. If my intention is I'm in my 28th year, I'm switching parish because Lafayette Parish has the best health insurance.
It's not what y'all tell us when y'all do your
But I'm just
survey.
saying, and then I'm coming, I'm retiring, and I'm getting all the benefits and only work 2 years.
Well, that's the way it goes. That's the pool. Then did you have?
So under the current plan, basically, it's based on years of work, is how it currently
Yes.
stands, period.
Yes.
And so we're looking at, you're suggesting the change would be, what, could you specify the change again?
Years enrolled in the health.
In addition, the current policy is far more graduated. It's a 20% every year of service.
And that's going back almost what we had before 2015.
Mother, what's the purpose of the change from what Justice said was approved from 15 to what you're suggesting? What's the reason?
What I'm suggesting is not to penalize those people who were hired here, who came here and joined as soon as they were hired. They've been here maybe only 5 years, but they've been enrolled in the plan the whole 5 years. They had no opportunity to spend 10 years on the plan.
So how many people are being penalized to help those people to make the change you're going to change? Do you have any idea?
How many people are penalized right now? None, because we haven't been able to program it.
2018, when you program it.
How many people would retire with fewer than 5 years working for us? I can't imagine there'd be very many.
Well, certainly we would be able to determine who would have been penalized, right? Not who is, but who would have been had we implemented this. We must have-
HR might be able to.
Well, I would know somebody.
Well, they would have, what they would do is they look at the data prior, the people who retired, what their data prior was. Because they can't look at data service, because that's going to show all parishes. But they could do it that way.
So maybe we could get a couple of what-if scenarios.
Okay. So y'all want to see who retired with fewer than 10 years here?
Yes.
And the policies that they've got.
And take policies.
And then,
from
Mama,
starting.
this conversation
Going
we had
through
before, this is not, we've talked about this before, it's not that we did that in the federal. She never implemented.
Just to maybe give you.
So right now, we don't have, there's no record as far as somebody's been on the plan for 3 years.
And it wasn't
5 years, 6
50,
years.
let's go further back.
Sick of the drain that was.
Yes, yes.
Now there's
Nobody wants to talk about that.
There are start dates.
Molly, can we also have a copy of the existing policy that Justin's talking about?
It's attached.
It's attached to the.
Yes, ma'am.
I did my homework.
Thank you, sir.
You're welcome.
Just wait. Did you use it? This meeting. Click on
Well, I work with other groups who do that like this. Any more assignments for me?
Justin did his homework.
Yeah, well, he always does.
I was the one who wrote the policy.
There you go.
And you got a good memory.
All right, next item on the agenda, if there are no more questions, stock loss cover. Mr. Fontaine.
Ms. Rona asked me to present to you guys the reasoning why we have where our deductible is for our reinsurance and what basis those decisions are made on. I'll tell you and explain to you what we're actually talking about. If you remember from past meetings when we kind of discussed the structure of your health plan, you have what's called a partially self-funded plan. Blue Cross obviously is your carrier, but their function in your plan is to process claims and provide you with a network, the discounts of that network, and all of the other things that are involved in administering a health plan. So Blue Cross is not your insurance company. You are your insurance company. You're funding your claims. Okay? The board portion is the majority, and of course your contributions are also in there. So to protect the financial integrity of the plan, you purchase what's called reinsurance, so that when you have an individual that has a high-cost claim, that a multi-million-dollar claimant does not destroy the financial integrity of the plan. And folks, multi-million-dollar claimants do exist in this day and age. You know, we've all been around this industry long enough to know that for years it was $1 million major medical policy before the alphabet soup of healthcare started. Then you had HMOs and PPOs and ACOs and all of these types of things. You started to see 2 million, then 5 million, and now with the Affordable Care Act, coverage is not limited on an annual basis or a lifetime basis. So what the reinsurance does, it limits the financial liability to the system, and that deductible is set at $500,000. So that's when the question came in, what's the basis of, is that deductible seems quite high. Why don't we have a lower deductible? So industry standards on your size group, you can see from the handout on a 5,000 life group, the industry average deductibles are anywhere from 600 to 700,000. Obviously, with a school system, a little more conservative, that type of thing, your $500,000 deductible is not certain out of line. It's certainly not too high. So the question is, why do we have this $500,000 deductible? It seems a little high. First of all, it's lower than industry standard by some 17 to 29%, which I have in item 5 there. Secondly, your premiums that you pay for the your reinsurance has been quite favorable. That only amounts to about 1% of the total cost of your claim. So it's not a significantly high item. You'll see that the average premium is about $16.88. If we multiplied that by the 5,355 employees, the average premium for a $5,000 deductible, we would be paying $90,392. Our premium for this year, based on those 5,355 employees, is $47,927. So not only do we have a competitive deductible, we have very competitive rates. This year's negotiations, we went to 17 reinsurance carriers. 14 of them came back and said we can't compete with that rate structure. 2 carriers submitted proposals. One was 39% higher, and the other one right at 45%, 44.8, anywhere from $223,000 to $257,000 higher than where our renewal is. So we're quite competitive in both premium and deductible, and I can report to you at this current period of time, we don't have anybody near 500,000. We have one at 301 claimant, but in past years we have had some claimants. I can tell you this past year I had a claim of $3.8 million, which was from a 4-month hospital stay for a double organ transplant. Okay? So this coverage is quite important to the plan. It's very economical coverage. Your claim statistics has allowed for very favorable renewals and very favorable rate structure. But as far as where your deductible is set, it's very competitive and it's in line and actually under.
I was going to ask, is it too low?
What's that?
Is it too low?
Well, we look at, this is how we do that. Good question. When we look at the renewal marketing, I always look at higher deductibles, okay? And so let's say that we looked at a $550,000 deductible. We better save more than 50 grand in premium to go to that risk, okay? My multiple that I like to see is about 2.5 to 3 times, okay? So you look at that and you know that you should, on average, have maybe 1 to 2 of these claimants that hit that type of mark there. So if the premium savings don't give you enough room to have 1 or 2 claimants, then it's not worth your while statistically. So that's always looked at as well. But if we can keep this deductible at that $500,000 level and not have to take on large rate increases and keep our rates, well under market and that type of thing, we'll do well. But due diligence, whether we're getting a rate increase, a rate pass, or sometimes you have a rate decrease, the due diligence is we'll market this thoroughly and negotiate every year.
Yeah, I looked at some numbers y'all had tossed out from one of the previous years, and I don't remember the exact percentages, but I want to say it was something like 12% of our claimants handled 80% of our costs. It was really high, and that's why I had a question about exactly what our stop loss was. And did our current carrier decline to actually price out a lower deductible, as in $250,000? Or we didn't seek that
We
information?
did not seek that information because it would be cost prohibitive.
Well, I mean, wait, time out just a second. At any point in time when we have a deductible, the insurance company's making money off of it, or they wouldn't offer it to us. So we don't know that it's cost prohibitive until we actually see the numbers and make a decision ourselves. There's, at every point on the scale, whether your deductible is 250,000, 500,000, or $1 million, it's going to be cost prohibitive for somebody. But the insurance company's going to make money on it at no matter what point they price it out to.
Right, that's why I mean, saying it's cost prohibitive, because they're gonna make
like
that up.
you looking
They're taking
to-
on another $250,000.
Well, I understand that, and they're going to charge
Yeah.
us. But that may be worthwhile when we look at the history of our claims, when, like I said, I think it was like 12% of our membership was 80% of our claims. So we're having, in the past few years, we've had some high-dollar claims. Do we have a count on exactly how many claims we've had over 250,000? Okay, so if we have a price structure, if we can get our current carrier to give us a bid at the 250, and we can look and see exactly what our claims are, maybe it is worth our while to investigate that further. The insurance company's making money no matter what level we pick.
Then why do you think it's not worth a while to go to 250? To ask for a bid?
Because you would be buying a deductible so much lower than with a 5,000 group risk would need, and you would be paying out far too much in fixed cost on your plan. So actuaries will look at the size of the case. They will look at your claims data, and they will come up with a deductible level for stop loss that's applicable to that size group. In yours, most cases in your size, private sector, okay, with 5,000 to 5,300 employees are buying specific stop loss deductibles of 6,000 to 7,000, no, 600,000 to 700,000. Your municipality and you know you're on a set budget, so usually a little more conservative at $500,000. We can certainly price out those lower deductibles for you, but I think you're going to get some sticker shock when you see what the premium.
More than likely. I was curious to see what price point.
We could go through the exercise.
Yeah, we should.
Nothing wrong with that.
Any more questions for Mr. Fontaine? Is that the last item?
That's the last
I have a
item.
couple of questions. The first one deals with long-term insurance.
Long-term care.
Yes, long-term care. It seems as though the understanding of most employees was that when you locked in at a younger age, that rate was standard. The older you are, the more the premiums. But then we received letters saying that a 25% increase, that seems pretty hefty. When you're thinking your premiums are going to, that's not new, that's not. But when you think your premiums are going to remain constant, and a 25% increase seems like that's pretty large. Do we have any information on, I mean, we all got letters saying the premiums were going up 25%.
From Unum?
Yes.
I just found that out a couple of days ago, in fact. So I will,
Can you check into
I will
it?
investigate it, and I will get back to you.
So I think it's kind of confusing because everybody was under the understanding when you locked in, that was it.
Well, you know how, what you said a while ago about
I
they could
understand.
pull that stuff anytime. But I'll check.
Okay.
It's from First Financial.
Yeah.
So they're the ones who negotiated that contract.
I don't know if this guy's their life insurance specialist. And that guy is pretty, I don't know how much he.
Back there.
Oh, Mr. Carlin?
Yeah, I came back.
That guy, there's that guy.
Unum offers long-term care?
Yes.
Okay, yeah, I'm not familiar with that product. I wouldn't be able to tell you the details on that one, but I can definitely get
Can
back
you
to
check
you.
with any of the
Yeah.
others and find out?
Absolutely.
Thank you.
Okay, thanks. I just find it, I mean, you know, I understand the premiums have to go up 25%. Hefty increase.
And the long-term care market has been really bad. Because I
Oh,
looked
yeah.
into it,
And you're right, I don't know, a lot of companies have pulled out of that market. Because I looked at it last year, and I even looked at other options, and it's, a lot of insurance companies just aren't offering it anymore. And I think there's probably some reasoning.
Well, Matt, you
So you're absolutely right.
threw some figures out earlier about that.
Yeah, so here are the figures I know about long-term care. 45% of all Americans today will qualify for long-term care at some point in their lives. The amount of stay is 2.5 years. And also for the private market, 4 out of 10 will be approved. So the major companies who do long-term care, it's approval or denial. And 4 out of 10 will get it. 1 out of those 10 will get a high rating. They all rate differently, but only 1 out of the 10 will get the highest rating possible. 4 out of 10 are accepted. So those are the stats on long-term care. It's a very competitive market, and very few, even big companies do it. So I would love to elaborate on some of the increases, but I just don't have the info on that.
But when you get it to us.
I will.
Okay.
And I stuck around so I can know when the next meeting is and meet more people, so I'll get to that to y'all as soon as I can.
Thanks, I appreciate that. Second request, I don't know if it's possible, but since we're meeting quarterly, is it possible so that we can compare, say, starting next year, first quarter of 2018 claims, premiums as compared to 2017? So at the end of the year, it's not a big surprise, guys, we're in a sudden hole. But at least make some comparison as to how our insurance is doing or the status of it before we get to the end of the year. And that way, nothing will be a big surprise. Thanks.
Anything else? Any questions? Meeting's adjourned. There's some objection.
Huh? Is that what you said? Oh, I didn't say anything. I thought you meant